Hello everyone, I'm Mark Sain and welcome to Sain Investment Solutions. Please take a moment to pause this video and review the following disclaimer. Thank you for that. Welcome to week 46 of the Forex market review. Today we're going to look at three trading pairs, see what's happening with the markets and which way they may be delivering. Last week we had the US elections on, which made the markets a little bit volatile, and you would have seen that I didn't send out a weekly video based on that volatility. When the markets are too volatile, it's probably best you stay out of the market because then trending based on whatever news is coming out of the market. And what you would have seen is as soon as Trump was known to likely be the victor, the markets just tanked. And then all of a sudden, a couple of hours later, when he's made the victor, the markets have reversed. So anybody who tried to jump on that ship that was sinking, then it rode itself up and away it went again. So that's why we don't trade any volatile markets. We want it to settle down and then get into a trade. So now that the markets have settled down, we'll look at those pairs which could deliver some great results. So the first pair we're going to look at today is the pound USD. So starting on the weekly time frame, we see this large AO down the bottom here. So we're going to assume that this movement all the way down here is wave 3 with 1, 2 down for 3, and looks like it's pulling back for wave 4. On a daily time frame, we can see 5 waves lower. We see this move down here with large AO coming back above the 0 line, back for wave 4 and then down for 5, and now giving us some AO divergence. So with our lower low end price and higher AO on the daily time frame. Dropping down to the 4-hour chart, we see this wave 3 down the motion here. It never physically came all the way below, so it could still be wanting to push back higher. And we just want to see which way the market may go. But what we can see on the reverse direction is our divergence. So we see our higher high in price with our lower AO. And then jump down to a 1-hour chart. We can see pretty much the same area, higher high in price with a lower AO. Just lower, not by much. And now we see this pushback lower with the break below the 200 EMA line. So now that we're seeing that, we want to see it find some support here and push back higher. It's very likely if we look left, it's probably going to come to this area here where it's bounced a few times. And if we can look at getting in somewhere around those levels here, we could be looking at a 150 pip stop loss, riding it down to this DSR zones of about 400 pips to 450. So we could risk a good 1 to 3 risk to reward we may be able to make on this trade. So that's a good setup. But because on the higher time frames we do have our divergence, this is very likely on the daily chart up for 1, down for 2. So when it comes down for 2, it's going to come down to zigzag patterns. So it's probably going to come down to those levels there. So getting out at that DSR zone, which was indicated also on the 1-hour chart, which is a daily DSR zone, that would be a good reason to look for an area and make your 1 to 3 risk to reward. The next trade we're going to look at is the USD CAD. As we can see, it's been stepping up this US dollar, and then it's had the big fall here, and now currently a rally. So we still see this looks like wave 3, coming back for wave 4, pushing back up for wave 5. Now this could be an A, B, C, and it could like to retest this weekly 200 EMA line. Dropping down to the daily chart, what we can see is starting to step up higher with our divergence occurring as well on the daily chart. Dropping down to the 4-hour chart, divergence is also confirmed. We'll draw it in with our higher high in price and our lower AO. We're probably likely to see it come back to at least the 200 EMA line on the 4-hour chart but very likely you might want to pull back to this daily DSR zone. But looking left, you still have some DSR zones around these levels here. So if I go ahead and just drop in some points there, so when we look at lower time frames, we can see roughly where they may meet up. So now we've got the 200 EMA line on the 1 hour chart. We have our divergence on this one as well, with our higher high in price and our lower AO. And what you'll notice with all my trading is if I can see divergence on the 4 hour as a minimum, and then hopefully on the 1 hour as well, then that's the way I like to take my trade. I like to see the market lose steam, then reverse, find some support, and then rally back higher. Where would I like to see it rally to? Well, if this is 1 up for 2 and down for 3, you go from the high to the low, come back to around the 50% mark. It's got to come back to at least a minimum 38.2 for wave 4. So we'll say around about there. If you got in around these prices here, depending on your personal strategy, you can look at putting stop losses between 50 to 100 pips maximum. And getting to the first zone, you're probably looking at about 200 pips. So even if you had the more conservative 100 pip stop loss, you can easily make your 1 to 2 to this first DSR zone, which we identified on the daily chart there. So that would be a good risk to reward. And if you took obviously a bit more riskier trade and just used a 50 pip stop loss, then definitely you can make a good 1 to 4 risk to reward. So, play it based on what you feel. And if you need a larger stop loss, obviously you need to go for more. Always make more than what you lose, because that's how you win in the long run. The last trade we're going to look at, which is very similar to the USD CAD, is the USD USO, which is the oil trade in the US. So the Canadian dollar will strengthen as the oil strengthens, and vice versa. So here we have on a weekly chart, our wave 3 back up above the zero line, and then a higher low, which is our wave 5. So we have a lower low in price and our higher AO. Now, before I go any further, I have been asked the question, these rules seem so simple, why do they work? And that's the point. The rules are so simple, they just work. It's because history has shown when you see divergence with the price moving lower, but it's stepping up higher, it's people paying more, or in this case, they're trying to pay less for a product, and then it becomes valuable. So as it's stepping down, unless people are sort of wanting it, then that's how divergence occurs, and you just got to keep that in mind. It's easy in the uptrending way to determine that, because in an uptrending market, as it steps up and we get our divergence, that means people are getting greedy, they're paying more for it, the stock or the share or the currency, but less people are wanting it. So that's divergence. That's the easiest way to put it. And just like if you're going to go to an auction for a house, when you see a house go up in value and it keeps going up and up and up, the buyers start dissipating, and then you're just left with 1 or 2 until the auctioneer shuts off the market and the winner wins. So that's divergence, where at the beginning, when the price is really reasonable, lots of people want it, but when you see the price go up and less people want it, that's the clue it's probably going to turn. What you then need is some significant move lower. So in this case, we've had a couple successful trades in the USO USD, and we had a couple moves up here. We won twice in a row. We won here, and then we recently had a win on the way down here. So again, I like the USO USD because, again, they're going to be talking about that agreement, which is going to be finalized with the oil roughly around the end of November. So if they come to some agreement and lock in a price of $50 a barrel or something like that, then it's very likely that this will push back higher. So since there's still a chance they could secure some type of agreement, and it's bouncing off this daily DSR zone, definitely it looks like an opportunity to go higher. First thing you want to do is use your daily DSR zones or look left to find where it's bounced a few times and draw those in. We've seen it push back higher. We're seeing our divergence, again, lower low in price with our higher AO, and that's divergence on the downtrending. It's now pushed back higher. It's broken these highs. So I'm expecting to find some resistance around this 4-hour 200 EMA line. I'd want it to see it pull back. So I'll draw in my Fibonacci retracement tool. I would keep moving this up depending on how high it goes before it really pulls back. See it pull back to around the 50% is where I like to get it. Looking left, I can also see it's bounced quite a few times. You can see it's bounced for quite a few times around that area, so that's probably going to be a good support zone. So getting it around there, doing a very conservative 200 pip stop loss to the first target area, you can make 400 pips. There's your 1 for 2. If you want to go higher, you can make over 600 pips. There's your 1 for 4. So it's a good risk to reserve. If you want to be a bit more aggressive and have 100 pip stop loss, you can make 1 to 4 to that level there. So that's why we love the risk to reward, because I only have to get it right 30 to 40% of the time and still make money. So we have our divergence and we're waiting for that pullback, dropping to the 1-hour chart. Again, we have our divergence, lower low in price with a higher AO. So really, let's see if this pulls back. We see this AO come back to zero line, indicating this large movement of wave 3 has ended. Pullback for wave 4 has occurred. Look for buying opportunity and let's see it run back higher again. So thank you for that. That was week 46 of the Forex market review. Please follow your own personal trading plans. This is just some general advice only, and seek your own professional advice. However, make your trade rules simple, back test them, and then follow them, and slowly increase your risk. Start very low with a 0.5% per trade, and then every 3 months, if you're having winning trades each month, then slowly move up that risk, because that was going to build the confidence in your system, and it's not going to allow your emotions to be heavily affected in the market. Because when you're trading $1 to make $2, there's a lot more emotional difference when it becomes $100 or when it becomes $1,000. So that's why we need to slowly increase our risk. And you'll get there. It may take you a year, it may take you 2 years, but at the end of the day, you'll get there. And where would you like to be in 2 years' time? Where you are now, or being successful? Here at Sane Investment Solutions, we wish you all the best in your success. Take care. Bye-bye.